Good evening everyone, and thanks for tuning in this evening to the FSM Choice Awards. My name is Xing Yan and I'm part of the research team here at IFAS, and tonight I'll be running through with you the much anticipated recommended funds list for the upcoming year. So since 2001, our research team has been publishing the recommended funds report to help investors make informed decisions while investing. Given the wide and increasing variety of funds available for investors, this list should help to reduce some of the choice paralysis that investors may have, as well as serve as a good starting point in building a well-diversified portfolio. Our recommended funds span across equity and fixed income asset classes, covering global, regional, single country, and some sector-focused strategies. The list is updated annually to ensure that our recommendations remain current and relevant for all investors. In choosing the funds that make the list, emphasis is placed on long-term outperformance rather than short-term market conditions, which could change in the blink of an eye. So without any further ado, presenting the recommended funds list for 2021-22. So for the 2021 edition, we have a total of 45 recommended funds that have demonstrated their ability to deliver long and consistent risk-adjusted returns over long-term horizons relative to their peers. We have added two new categories, Asian property and Chinese bonds, with their funds being the Manulife Asian Pacific REIT and the Fidelity China Renminbi bond. China's fixed income markets are steadily becoming more accessible to investors, and with value hard to find in global fixed income markets currently, it is a timely addition to the list. Property is also an attractive consideration as both a reopening and cyclical play, but also serves as a strong inflation hedge. Asia Pacific REITs have also weathered the COVID-19 storm exceptionally well, and investing through a fund provides a hassle-free, diversified approach to an attractive sector. In addition to new categories, there have been some fund changes in the existing categories as well, which shouldn't be surprising considering how volatile markets have been in the past year. 8 new funds have made their way on the list, in many fund categories that should be of great interest to most investors as well. So that leaves us with the question, how do I incorporate these new funds into my portfolio? So firstly, let us take a look at the Fidelity China Renminbi Bond Fund. Fixed income portfolios should achieve the goals of stable income and low risk to principal, but with rising rates and many fixed income markets trading at or near all-time highs, this is proving to be a challenging goal to achieve. However, Chinese government bonds remain one of the last fixed income markets that fulfills these requirements. There have been plenty of chaos in the Chinese high-yield bond market in recent times, but unlike their high-yield counterparts, Chinese government bonds are not exposed to that significant credit risk. Instead, they sit in somewhat of a sweet spot, providing decent yields without being overly exposed to credit risk. Significantly, they have also stayed free of the contagion affecting high-yield markets, registering positive returns on a 1-month, 3-month, and a year-to-date basis. In addition, this attractiveness is further enhanced by its low correlation to other key asset classes, making them an excellent option for improving diversification. Interestingly, they also exhibit low correlation to US 10-year Treasury yields, making it a good choice when most of the world is concerned about rising US inflation and rising rates. As China's economy grows larger, more investors are looking to gain exposure to its burgeoning financial market. While there have been steps taken to increase accessibility to foreign investors, Chinese investors are likely to adopt a measured approach, and therefore investors should view this as a long-term structural theme. The inclusion of Chinese government bonds in major fixed income indices may also drive further foreign participation in the future. According to a research done by BNP Paribas, between USD 200 to 300 billion would flow into the asset class as a result of its inclusion. This would likely lead to higher demand and price appreciation for certain segments of the Chinese bond market. In short, the Chinese bond market scale, diversification potential, and relatively attractive yields make it hard for one to ignore. The fund will likely appeal to many types of investors: risk-averse investors seeking a relatively safe and low rate of return, global investors seeking uncorrelated sources of returns, or investors simply just worried about inflation eroding away their purchasing power. If you fit into any of the above investor types, allocating some of your money into China government bonds will be highly suitable. REITs also provide a high income with the potential for moderate long-term capital appreciation, making it especially relevant considering how low yields are today. Often favored by retirement savers or retirees who require a continuous passive income stream, REITs are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. So these dividends come from the income generated by the real estate assets, which come from contracted rental cash flows. As such, investing in REITs generally provides stable, recurring dividends every year. However, this does not mean that REITs are not an attractive deal for other investors. Friendly taxation rules, steady dividend income, and long-term capital appreciation has allowed REITs to deliver competitive total returns historically. Their comparatively low correlation with other asset classes also makes them an excellent portfolio diversifier that every investor should give key consideration to when constructing their portfolio. REITs have stayed largely resilient during the pandemic outbreak due to measures taken since the GFC. When the pandemic began, overall leverage ratios for REITs were at or near their lowest on record. These precautionary measures have helped the REIT sector tide through the most turbulent year. With capital markets worldwide reopening, there is an uptick in growth-oriented M&A transactions within the REIT sector that reflect growing optimism in business models and sector outlooks. REIT earnings have also recovered substantially to about 85% of pre-pandemic levels. So having entered the downturn with strong balance sheets and liquidity, REITs are now well poised to ride the reopening wave. So a common topic of contention for REIT investors is undoubtedly the potential threat of inflationary pressures as economies continue reopening. The argument put forth is that if interest rates rise due to inflationary measures, the profitability of REITs will suffer as their highly leveraged nature will mean higher interest repayments, leading to lower returns. Theoretically, this means that investors should avoid REITs in a rising rate environment. However, in reality, rising interest rates are a result of an improving economy, which is positive for REITs as it allows them to grow occupancy rates, hike rents, and build new properties. This helps to improve revenue and cash flows. So also due to the modest amounts of gearing used by REITs as a precautionary measure, as mentioned earlier, the positive impact of a strong economy more than outweighs the negative repercussion of higher interest rates in most cases. We would also like to highlight APAC region as a stellar region for REITs, as their strong balance sheets and growing business confidence in the region makes it an attractive choice as we head towards an inevitable opening. We particularly favor the Manulife APAC REIT Fund for its heavy exposure to Singapore REITs, as our high vaccination rate makes it a strong recovery play and also a strong choice for future growth opportunities. In addition, the fund's high retail allocation offers two benefits. It is a strong beneficiary of the recovery play, which should be supported by the vaccination rate, as mentioned earlier, as well as the move towards an endemic society. In addition, suburban retail REITs provide much needed stability as they remain resilient amidst lockdown due to the clientele they service as well as the products and services they offer. We believe that there are many opportunities in this market to be seized, both as a strong recovery play for future growth opportunities, and this is especially so for investors looking for income. And while we would like to go through each and every one of our changes in detail with you guys, that would probably mean we'll be here till next week. However, we would like to take advantage of this opportunity to highlight a series of articles on our website under the term Fund Friday, during which we have already covered some of the new funds added to the recommended funds list, including those in the two categories that I have already highlighted earlier. Some of the other funds were also highlighted in other articles that we have written throughout the year, including our top 5 picks for the second half of the year, so do check the article out if you haven't yet already. Don't worry, we'll be uploading an article right after this presentation, where you will be able to access the entire 2021-2022 recommended funds list, as well as links to the articles featuring these funds for your convenience as well. So do keep an eye out for that. With this recommended funds report, we hope to jumpstart investors' investing journey with this single step, given the plethora of funds we have on this platform. And investors who are finding it hard to make a decision or are new to investing may refer to the report for ideas, whether to serve as a starting point or just a manner to execute your investment ideas. So whether you are a seasoned investor or looking to take your first step, this list should serve as a guide for you to take action. With that, thank you, and now I'll pass the time back to the MC.